Hi, I'm Josh Cadillac, and welcome to my podcast, Know Your Shit. I've been blessed to see great success, as well as seeing the bottom up close and personal in 2008. And if there's one lesson I've learned is that if you want to have success and differentiate yourself from everyone else out there, you need to know your shit. As a successful real estate and crypto investor and an educator, it drives me insane that people do not immerse themselves in their craft. Everyone is so busy advertising and testing new sales techniques, they forget the most important thing, the product. Here I want to talk to the folks that got this right, the most successful people in the world in every industry. Bring them to you and find out what they learned in their business that made it great. When you listen to my podcast, you will know for sure that the topics and experts we have on have one thing in common. They know their shit. Hello, everyone, and welcome to the Know Your Shit podcast, where our knowledge and pride in what we do drives us to be excellent. My name is Josh Cadillac, and I'll be in the driver's seat for today's show as we strive to learn how to stop doing deals and start closing for life. We have a great show for you today. Without further ado, let's get started. I wanted to take and talk. On this show, we get together a lot of industry experts, a lot of folks that have been successful, to ask them how they've done it and figure out what the secret to success is, right? But what I want to do today is kind of help those folks that are in sales, and in a particular kind of sales that I'm very familiar with, which is real estate. In real estate right now, we're in a very interesting market, always an interesting market, but a particularly interesting market right now. And the number one question customers are asking us is this another bubble? Is this gonna burst? Are things getting ready to change? Should I be on the sidelines? And honestly, we get asked the question a lot, not even as a question, but more as, well, we're just gonna take our money and sit in the sidelines and wait for the bubble to burst and the prices to come down. Well, here's the thing. If folks are saying that, what are they basing that statement upon? We got to ask that first, because folks, closing for life always starts in one place and one place only. It starts with the customer, who the customer is, where they're getting their information, how they're thinking, what matters to them, and what really matters to them. And sometimes understand this, what they say that matters to them is not what really matters to them. We have to be aware. We have to be super engaged with the idea of fully understanding our customer even better than they know themselves. And so when they're asking the question, or when they're saying, this is a bubble, it's going to burst, they're citing back to one thing and one thing only. They're citing back to the crash of 2008. So the first thing we have to do if we're going to take and have that conversation with the customer is make sure that we understand what actually did happen in 2008. So what did happen, right? What happened in 2008? Was it a supply side issue or was it a demand side issue? For starters, that's the only two things that make a market right there, supply and demand, right? So was it a supply side issue and a demand side issue? When I ask this in conferences that I teach all over the country, agents don't know. And more times than not, they pick that it was a supply side issue. There was too much supply. Well, the problem with that is the supply that we had was actually not sufficient for the demand that we had in 2007. We still had a housing shortage. We still had more people looking to buy than we had houses. The issue was not a supply side issue. The issue was a demand side issue. We had demand that was created by lenders making people that otherwise would not or could not be buyers into buyers by virtue of the different lending standards they put in place. They lowered their standards to allow people that otherwise probably couldn't and definitely shouldn't at this point have gotten a loan to get a loan. These folks then added artificial demand to the market. So if we had a supply and the supply is at 10 and that supply of 10 perfectly matches the 10 people that are looking to buy. And now we take and change the criteria to become a buyer and make it so that 100 people can buy. Well, now we have a situation. We don't have enough supply. So early on in the housing buildup, that a situation happened. The banks slowly started changing their lending criteria and the demand for homes kept building and building and building. And so as it built, well, I can tell you folks, in addition to being an agent, I'm a general contractor. When I see there's a demand for homes and I can make homes and I can make a profit, guess what the first thing I start doing is figuring out how the heck I can make more homes, right? So that's exactly what builders and developers did. They started building more homes as quickly as they possibly could. Well, that demand was all seeking to catch up with a supply that was already that supply was seeking to catch up with a demand that was already spiking. So what happened? Well, at some point, lenders realized that these loans that they were making that they thought were going to be okay, turns out they weren't so okay. These folks that they had given loans to were defaulting at a much higher rate than they anticipated. And those defaults were actually starting to cost them serious money. And more so than that, those loans that they had already repackaged up, because banks make loans on homes. Those home loans, they then package up and sell those loans onto the market, into the stock market, and into other places where those loans are bought. And that's how the bank gets new money in order to make more loans. The banks don't have an infinite supply of money. So they make their loans by selling the loans that they've already made. That's how they capitalize themselves. So our banks realize, hey, look, not only are these folks that were buying our loans not willing to buy any more of these loans, they're looking for a refund from us because we made these bad loans. Oh, no. The automatic response they have is stop lending money, period. So now we had a buyer supply of, let's say, 1 million that could qualify for a loan, because basically if you could fog up a mirror, you could get a loan. And in fact, if you couldn't fog up a mirror, they usually had a guy they could bring in to fog the mirror up for you. It was that easy to get a loan back then, right? Well, now that criteria changed. The bank went not back to the lending criteria they had in the past that was a good, safe lending criteria. They went draconian. They turned off all the flow of money. It was almost impossible to get a loan. So you had a buyer demand of 1 million buyers, let's say. And overnight, that demand, those people that could buy, turned into 6 people that could buy. Because these were some cash buyers. There were a few folks that maybe still qualified for a loan, but everybody else, they weren't lending money. So now you have a demand that is far too small for the existing supply of homes that you have. Well, what do you think happens when there is an oversupply and an insufficient demand to match that supply? Well, prices have to come down. Prices come down. Why? Because when the prices come down, it attracts buyers to come into the market. So now home prices are coming down to try to attract buyers back into the market to create some market stability, to gobble up this excess supply that we have and reach a place where the market supply and demand are properly matched. Well, the problem is the nature of the loans that the banks had made. The loans they had made were put people in positions where they had very little equity, very little portion of the home was theirs in the first place. So if you're putting only 3.5% down, or some of the loans were 0% down, or some of the loans were even negative equity loans where they covered your closing costs, you went in being upside down in the house. And now that home is no longer appreciating to get you out of that negative equity position. Instead, it's going down in value, putting you in a worse and worse and worse equity position. And sometimes you wind up so upside down that the bank is calling you up and saying, hey, look, you have to settle out your loan because you're too upside down. So what happens in that situation? Well, people are no longer incentivized to keep these homes that they're $50,000, $100,000, $200,000, $300,000 upside down on. They have no incentive to keep those homes. So they take and they sell those homes, or they attempt to sell those homes as short sales, right? They can't sell them as a regular sale because they would owe the bank a bunch of money. So their choice is to sell the home and write a check at closing to the bank for all that they owe, or to do a short sale, or to let the home go into foreclosure. Now, believe it or not, I'm in the Miami-Dade and Broward market, and I used to watch the market carefully. And you would think we were the epicenter of the foreclosure crisis in 2008. So I was in the business in 2008 doing this thing. The highest number of single-family homes that I ever saw available on the MLS at any one time that were foreclosures in single-family homes was about 800 homes. Out of a market of about 36,000 homes that were available. It actually got as high as 39,000 in single-family homes. Condos, it got to be 42,000. but 39,000 single-family homes in Miami-Dade County, the largest county in Florida. The number of short sales, by the way, made up of more than half of the 36,000. There were significantly more homes on the market for short sales than there were actually foreclosures in Miami-Dade County. And in fact, all over the country, you find that to be the case, that there were a lot more short sales done than there were actual foreclosures done. Florida being one of the states where it's a little bit harder to get the foreclosures done than some of the other states. And that's the reason why there are a lot of short sales done here. But that was the 2008 market. The 2008 market came to be by virtue of an overrepresented demand that was created by artificial buyers, and a supply that was struggling to catch up when all of a sudden the music stopped and all of this demand dried up overnight. So that was 2008. So we need to look at today to see if today is a good corollary for that. If I'm going to talk to a customer, if I want to take and understand this market myself, it's a place where I got to start, right? So let's look at today. What's going on? Are the banks making those loans? Let's start right there. Let's look at the demand side and see if the banks are making those bad loans. So first-time mortgage application approval rates. This is the buyer walks into the mortgage broker, first time in the office, and says, hey, I want a loan. What are the odds of them coming out of the office with a loan? In 2007, that person got approved 98% of the time. Today, that person gets approved 35% of the time. So obviously the banks are not lending everybody money. They're being much more cautious with their funds. It would seem, at least, right? So, all right, it doesn't appear that we have an issue there. How about, what are the odds maybe of the buyers going away? Like the demand drying up. Well, currently the ratio of demand to available homes, depending upon where you look, is around 10 buyers to every one home. With interest rates coming up, that has slowed some. So let's say, I haven't got an updated number since we've gotten to the rates where we are at right around now. Let's say we're at 8 buyers per home. In order to have a neutral market, you have to be at 1 buyer per home. So we still have a market that has demand that far exceeds the existing supply. So it appears that the demand side is okay. How about the supply side? Is there something on the supply side? Because the only other thing we could say on demand side, maybe, if we want to stay there for one more second, let's back it up and just hit that for one more second. What's the thing that's going to make the buyers go away? Well, the only thing that we could really point to is interest rates, because even if there's a recession, it's not going to make buyers stop wanting real estate. It just means that real estate might be one of the only places that they can make money because the other markets aren't doing so well. Real estate tends to be a place where there's a flight to quality. People tend to flee to real estate when there's a recession. So, okay, what happens then if interest rates go up? Well, why are interest rates going up in the first place? They're going up because of inflation, right? Inflation is the big factor that's causing interest rates to go up. When interest rates go up, what do you think happens to rents? Well, rents have to go up as well. Do you think that the rents going up provides an incentive for buyers or for tenants to want to buy? Of course it does. And here's the other piece of that. When there's inflation, what do you think happens to home prices? They go up as well. Historically, that's always been the case. So when we have higher inflation, we have two pressures working to take and make and keep real estate incentivized. One is our tenants, the people that are tenants, are watching their rents go up every single year and having very little power to control it. And they're not going up like they were before, 2.5 to 3.5% a year. Now they're going up 8, 10, 12% a year. Down here in Miami, we had rents go up some places over 50% in a year. And the other piece is, with inflation, real estate prices tend to go up because with inflation, it's not the real estate that's changed. It's the money we're using to buy the real estate with that's changed. So if that's the case, right, if rents are going up and real estate prices are going up and you're a tenant, you're literally watching your housing expense go up, and you're watching that home that you could have bought appreciate and appreciate and appreciate. One of the best lines I've ever heard in real estate is this one: the difference between experiencing inflation and appreciation is ownership. If you own the property, as all of my folks that bought last year can attest, yeah, inflation stinks, but man, it sure feels good when I check the value of my home and I have an extra $100,000 in equity. Our renters have nothing to show for this inflation, whereas our homeowners have a home that's significantly more valuable. So again, let's get back to this idea though, because I was a little bit of a little bit of a tangent we went on to take and tighten down the foundation a little bit. Let's get back to looking at the supply side. Is the supply side building homes as quickly as they can? And I'm talking about the developers. We're talking about all the sources where homes can come from. Are developers building homes as quickly as they can? I'm going to tell you as a developer, yes, we are. If we can get our hands on the materials, we're slapping the houses up as fast as we can. The thing is, we've been kind of dormant for a long time. We've been going real slow. We've been slow rolling because the market hasn't had this kind of demand. And now the demand is off the charts. So what about, so if the developers are building as fast as they can and they're not able to keep up with the demand, what does that mean? Well, it means that this is going to persist. We're going to persist in an undersupplied market for a while until developers catch up, unless, big caveat, is there another source of inventory? So let's talk about the one that everybody was talking about a year or so ago. I was talking about it a year plus ago. I thought it was going to be a big thing, which was all the forbearances that were going to come due. All these folks that the banks gave a pass to during COVID. I was like, hey, look, these folks, they're going to be upside down. These may be distressed assets that we see hit the market. I was not anticipating the tremendous uptick in demand that we saw through COVID. The uptick in demand created an undersupply situation, which caused prices to go up. Those prices going up took those folks that were in forbearance, even if they owed the bank money and penalties for not paying for a year or two, guess what they still have in their home? They have equity. Look, folks, most people that owned a home in the last couple of years made about $100,000 in equity. Their home is appreciated. Unless you're in one of the places where people were really moving away from, you're doing really, really well. And there's a lot of reasons for that. There's reasons that we can go in on the investment side of real estate, and maybe that'll be for another podcast, about why the outlook for real estate as an investor still looks so good. The reasons why people are still willing to buy real estate, investors still willing to buy real estate at these rates of return that are as low as what we're seeing. That's a different story for a different time. Right now, I want to focus on this idea. I want to focus on this idea of the supply side. So we have a supply currently of existing homes, right? Though the current owners of those existing homes do not seem motivated to want to part with those homes. Can we foresee anything coming up that's going to make them want to sell their homes? Well, the reality of it is I don't see anything in any of the numbers and any of the metrics to indicate that there's going to be a new incentive for sellers to want to sell. So it's just going to be the usual stuff, people passing away, wanting to downsize. The normal life progressions are going to be what we see, but I don't see any major event that's going to drive sellers to be like, I got to get out of this house. So where is our additional inventory going to come from? And here's another piece of this equation. I can tell you as a builder, there's a certain price point that I can build for. And this is always the case with builders. There's a certain number that I have to build for. If I want to build a 2,000 square foot home on, a normal size lot, I know I'm going to have to sell that home for a certain number. I can't sell below that number. I can't project to sell it below that number and make sure I'm going to have the profit I need in order for this deal to make sense. So before I ever break ground, I figure out what I got to sell those homes for, right? Well, here's the thing. That number right now in my market, let's say, that number is 600,000, which means that there is an inability of the supply side, the developer side, to build homes that are priced below 600,000. Now I can use that number because it's not just me. I mean, I'm a small developer, right? I go to the big guys. They're not selling homes for less than 600,000 each either in my area. So what does this mean? Well, this means that all the homes, the older homes, the homes that if they came in the market would be priced below whatever that price point is, the build tipping point price point, the sale to build price point, all the homes that are priced below that price threshold are all that there will ever be. That supply of homes is fixed. And the only thing that can happen to that supply of homes is it can shrink. Home burns down, somebody decides to tear a house down and build something newer and bigger, whatever. So that market, unlike the market above that price point, the market above that price point, developers can take and build new homes. They can amend the supply. They can add to the supply. But in the lower price point, the price point below that, we can't, which means that supply is, because it's fixed, it should experience appreciation, not commensurate with the rest of the market. It should experience disproportionate appreciation because of the added economic pressure of scarcity. It's a scarce resource. Do we see the demand for homes priced below what builders can build at? Do we see that demand going down? No, that is the affordable housing, folks. We see that demand going up. So, I mean, if you're looking for the place as an agent to recommend to your customer, hey, you should look here, why not in the place where there's a fixed supply and a great prospect for that property to continue to appreciate? But either way, so is it a bubble, right? We've looked at the supply side. We've looked at the demand side. It doesn't appear that there's any way that the supply side can bring a huge influx of inventory to the market. And it doesn't look like the demand side is going to overnight flip a switch and go away. Obviously, interest rates going up are going to provide a pressure to make it harder for folks to buy homes. But inflation is sitting there on the other side of the equation, providing ample incentive for people to want to buy homes. They're literally watching their homeowner friends get wealthier while they're getting poorer. All that being said, if it's not 2008 as a historical corollary, and folks, I analyze real estate investment property. So historical corollary is what that's all about. It's figuring out what kind of market we're in, what market we've had before that's like this market, and what happened to real estate prices and real estate rents in that market. What market do we need to look at? Well, we need to look at the 1970s. And the reason for that is there's a big thing that wasn't present in 2008. Actually, several things. But the big thing that was missing was any reason why the home prices went up. There was no economic reason other than a whole bunch of demand came into the market. There was no inflation. Inflation was below 2% in the early 2000s, early and mid 2000s. Wages weren't going up. Wages were fairly flat. I mean, wages were not good at all through most of the 2000s. Going up at 2-3%. It was barely keeping pace with inflation. Wage growth was super low. So none of the things that would indicate to us that, hey, look, home prices should go up because of this economic reason were there. All we had was, hey, a whole bunch of people want to buy houses. I guess we should sell it to them. Right? As opposed to sitting there and saying, well, wait a second, is this market sustainable? So does inflation make a real estate market that appreciates in price sustainable? Well, let's take a look at the 1970s. Interesting factoid. In the early 1970s, at the beginning of that inflationary cycle, an inflationary cycle that was caused by the U.S. coming off the gold standard fully. At the time, the U.S. dollar was pegged to gold at $35 an ounce. Why don't you go take a look at what gold is trading, what your dollar buys in gold today, if you want to get your feelings hurt? It will certainly hurt your feelings, right? Your dollar used to buy, 35 of your dollars would buy an ounce of gold. Now it's closer, you need $2,000 to buy the same ounce of gold. It's crazy. That's how much your dollars come down in value. But what did real estate do in that period of time when that inflation kicked in? Well, at the beginning of that inflationary cycle, real estate appreciated 16% the first year. How did we do this past year? How did 2021 look for real estate appreciation? I'll tell you, it's darn near 20%, which means it's even more than we experienced in the inflationary cycle of the 1970s. By the way, to get your head around what happened in the 70s, from 1970 to 1979, the total inflation was 103.4%, which means your dollar in 1970 that could buy a dollar's worth of stuff in 1970 couldn't even buy 50 cents worth of stuff in 1979. The average rate of inflation through the 1970s was 9%. All the way into the 1980s, mid 80s, it was 9%. Do you know what the average rate of real estate growth was through the 1970s into the 80s? 9%. Perfectly offset the inflation. What does that mean? Well, as the value of the money went down, the real estate prices went up to offset it. This means that if there's inflation, it not only is it probably should it happen, it's gotta happen that real estate prices go up. Real estate must go up because the real estate itself hasn't changed. The only thing that's changed is the money that we used to buy the real estate. That money has become less valuable. And so if that's the case, we should not only be okay with prices going up the way that they have, we have to realize that it's a natural response to the market that we're seeing. So let me ask this question then. Let me drop this out there and see. Trivia question to the listening masses out there. When did real estate prices burst? When did the bubble burst? When did the real estate prices tank through the 1970s into the 80s? I mean, certainly when interest rates got up to 18 and 21% in the 80s, real estate prices had to come down, right? Nope. The first time real estate prices fell was in the early 1990s. So from 1970 to the 1990s, that was 91. Real estate prices did nothing but go up. And when they fell, you ready for this? For that person that was in 1971 sitting there saying, you know what? I'm going to hold on and wait for the prices to come down. That's right. That's what I'm going to do. Real estate prices fell 0.3% and then began going back up again. That was the big bubble burst that people were waiting for. That person that waited lost hundreds of thousands of dollars. They literally didn't have their money double or triple in that period of time that they would have seen. So our folks, is there a reason to think our folks that are sitting there by the sideline are missing the ball? Yeah, there is, folks. In addition to the inflation that's gone on, wages have gone up. Wages haven't gone up nearly enough to keep pace with inflation. But if wages go up, does that mean people have more money to spend to pay for rent and to pay for a mortgage? Yes, it does. The number one indicator whether or not you're in a stable, sustainable mortgage market is wages. Are folks earning enough more money to afford homes? Median home price and median income are a metric that people, when they're looking at the market, they always keep tabs on. Now, in my market, that the number tends to be different than the mass market, but in America in general, 2.5 to 3 times median income should be the median home price. Median home price should be 2.5 to 3 times median income. My market, that doesn't work because I live in Florida. Florida, I have a lot of people that come from all over the world and bring all kinds of money. They make a whole lot of money other places and come here. So it's more of a service industry place. So that number tends to be closer to 5, 5.5, 6, and still be okay, to still be a sustainable market. But understanding that if wages go up and inflation is present, home prices naturally have to go up. That is the reason why real estate has always had this great reputation as a hedge against inflation, folks. It's got the reputation not because it has a good PR company. It's got the reputation because it's actually really good at this thing. And when we look at on another show, when we look at the investment value of this, when we look at what investors are looking at and why investors are looking at this thing and saying, oh my gosh, I got to get in. I don't care what I have to pay. I don't care what the rate of return is. This is something I got to get in my portfolio as quickly as I can. Now, they're not saying they don't care about the rate of return, folks, but they're taking rates of return that are significantly lower than what they've looked at before. So when looking at this market and seeing what's gone on through the 1970s, through the lens of the 1970s, we can see that real estate prices went up a whole lot at the beginning of the inflationary cycle. And then as interest rates went up, that pace of growth slowed down. Real estate actually in 81 or 82 had its worst year. Prices still went up 1%. Now, 1% is nothing to write home about. But as a hedge against inflation, as something that where people kind of have a dependence upon the wealth building aspect of something that they're engaged in, It's a tremendous tool. And so here's the reason why I bring this up. And this is why it's such a big thing to me right now. As the real estate professional, as the person that's trying to close customers for life, as the person that's trying to build a business that they can be proud of, a business they can be on their deathbed and look back and say, you know what, I did something good here. Having the right answers to give customers, understanding not just what's going on in the market. Agents are great at telling me what's going on in the market. Oh yeah, there's not enough supply and all, telling me what's going on doesn't help your cause. You got to be able to tell people why it's happening. Because if you tell them why it's happening, all of a sudden they get a sense that you actually know what the hell is going on. Folks, the reason why people use an agent to buy a house is not because they want to pay somebody a percentage of the purchase price. It's because they're too scared to do it themselves. If you show them you get it and you deserve their trust to do this thing, guess what? They're a hell of a lot more likely to want to work with you. And if you're giving them good advice and you're helping them to make money because you know the market, you understand what's going on, people don't tend to find replacements for people that make them money, as it turns out. People don't tend to find replacements for people that are looking out for them. People that tell them stuff like I tell customers, what I always suggest agents say to customers, if it's not the best advice I got out there, I won't tell them. I only give them the best advice. So if somebody calls me up and says, hey, Josh, I'm thinking about selling, prices are really good in the market. I'm like, geez, man, I hate to see you sell in this market. I make money as a broker, as an agent, if I sell the property. But here's the thing. I don't want that deal. I want every deal that customer's ever going to do. And so I give him the right advice to earn his business, not for today, but for the rest of his life, the rest of her life, the rest of that investor's life. I want all those deals because here's the thing. If I'm doing what I got to do to earn those deals, if I'm doing the work I got to do to earn those deals, the person that's most benefited is the customer. If there's one person that wants to be closed for life, it's the customer. They don't want to be interviewing more agents. And the thing is, it forces me to run my business by a standard much higher than what I could get away with. It forces me to run the kind of business that I want to have, the kind of business that I'm proud to own, the kind of business that my being good at what I do is actually something that gives me value in my life, as opposed to work being something that we do to just earn a paycheck, to just survive. This is the mistake of the generation that we have right now. They look at work as something that you do to survive, to get paid so you can get to the real part of life. I watched my father's generation, man, and the joy and the pride they took in the work that they did. And I want that for myself. I want my work to be something that I can look back on and say, yeah, come hell or high water, we did great work. Regardless of what we could have got away with, we held the line. We did something to really be proud of there. And so being able to take and understand your market, knowing your shit, knowing what's going on, knowing what drives your market, knowing when you're telling your customer something that you're giving them the best possible advice, and you're putting your mind at ease by the way you explain it to them. To sit there and say, hey, look, I know this might be scary, but let me explain it to you. Now you get it. And even if they don't fully get it, the fact that you get it as well as you do to explain it as well as you have takes the fear right out of them. And they feel like, well, like I like to call it, like they got the 800-pound gorilla on their side. Everybody wants the 800-pound gorilla. Everybody wants the force to be reckoned with. And so in our ability to understand our market and to be able to explain it well and show our customers, hey, look, I know how this thing works, and don't worry, I got you covered. We're going to come through this. And then, you know what? You should kind of feel sorry for whoever the other side is going to be, because having me on your team, it's almost not fair. Well, it should be cheating. It's like a little bit of cheating. If I can make my customer feel like that, folks, the one thing they're not looking to do is replace me with somebody else. So that's what I want to leave you with today. Just roll that around a little bit. Think about your market. Key thing is to keep track of in a market. Things we didn't even talk about, but I probably will when we talk about in the investment side of real estate a little bit more. Gross domestic product. How good is the economy doing in the country? Wages. We talked a little bit about wages today. Unemployment. We didn't talk much about that, but hey, making sure people have a job kind of helps their ability to be able to buy a house, as it turns out. Inflation, a super important metric, not just CPI, consumer price index, but also be watching the wholesaler price index, how much it's actually costing people to make the same products they were making last year, what it cost them to make that same thing this year. Very important thing to see, because you want to take it and see what the profitability is of these companies and what you can anticipate inflation is going to be. It's great if you have numbers that are going to tell you in advance what the future is going to look like, right? And keeping your finger on the pulse of the 10-year treasury bond, which is the place where our residential mortgage interest rates come from. Super important part of this, folks. What the Federal Reserve does indirectly affects our mortgage rates, but it's the yield in the 10-year treasury that actually dictates what our mortgages are trading at, what our buyers can actually get loans at. So this is the stuff that I wanted to leave you with today to think about. I think that there's a lot more that we could go into on this topic. It's a topic I love quite a bit, actually. But I think that creating looking for a gap in the market, looking for a place to give yourself a competitive advantage over your competitors as an agent, this is the place to start. Because here's the thing. As I said at the beginning, I teach this all over the country. Nobody's talking about this. No one in real estate is talking about this. Because the one thing that they don't make a priority when folks teach real estate is knowing your shit. People know sales techniques. People know social media. But actually knowing the product they sell, if you want to distance yourself from the competitors out there, folks, just know what the hell you're talking about. That'll make all the difference in the world. All right. Implement it. By all means, do it. If you see one of my ACE classes, acecloser.com, you come see me in person or see me via Zoom. We'll do a class together. Love to see you guys. Thanks for listening, and I'll catch you next time.